Hello traders, and welcome back to Explain the Charts. Today is November 6th, 2025, and we are diving deep into the EURUSD, which has seen some dramatic price action this week. The pair has bounced sharply from a 3-month low, but the bigger picture remains complex. First, let's cover the fundamental news driving the market before we get into the charts. The primary driver for this recent euro strength is renewed weakness in the US dollar. This stems from mixed U.S. economic data that has traders questioning the economy's momentum. The ADP jobs report for October came in at only 42,000 jobs, which, while beating a low consensus, hardly signals a booming labor market. Furthermore, the ISM Services PMI, though still in expansion territory, points to a slower and uneven pace of growth. This data reinforces the Federal Reserve's recent decision to cut rates by 25 basis points in late October. While Fed Chair Jerome Powell framed it as a mid-cycle adjustment, the market is now pricing in a 62% chance of another rate cut in December. This dovish sentiment is weighing on U.S. Treasury yields and, consequently, the dollar's appeal. On the other side of the pair, the Eurozone is showing signs of stabilization. Recent PMI data has been stronger than expected, and retail consumption is holding firm. The European Central Bank, in contrast to the Fed, has maintained a neutral, wait-and-see stance, having already completed its easing cycle for now. This monetary policy divergence, with a potentially dovish Fed and a neutral ECB, is providing a tailwind for the euro in the short term. Now, let's see how this news is reflected in the price action on our daily chart. Looking at the long-term picture, it's clear that EURUSD has been in a strong downtrend since its peak near 1.1918 back on September 17th. We've seen a consistent pattern of lower highs and lower lows, which is the classic definition of a bearish trend. This downtrend culminated in a 3-month low set just yesterday, November 5th, at 1.1468. This 1.1468 level is now our most critical immediate support. It's the line in the sand for the current bearish leg. The price action over the last 24 hours shows a significant bounce off this level, which is the market reacting to that weak US data we just discussed. The bulls have managed to push the price back up towards the 1.1530 area, but it's now entering a heavy traffic zone. The primary long-term challenge for bulls is the descending trendline that has capped all rallies for the past 2 months. To even consider a trend reversal, buyers must decisively break this line. Let's zoom in on the price action since the beginning of October to get a clearer view of this recent struggle. Here you can see the sharp drop early in the month, followed by a period of consolidation, and then the final breakdown to that 1.1468 low. This sharp rejection and bounce is exactly what short-term bulls are getting excited about. However, notice that even with this bounce, we haven't yet taken out any significant prior highs from late October. This is why caution is warranted before declaring the downtrend over. Now let's drill down to the 1-hour chart to analyze the anatomy of this recent bounce. Here, the bullish case becomes much clearer on a short-term basis. We can clearly see the V-shaped bottom that formed at 1.1468. Since that low, the price has been carving out a series of higher highs and higher lows, a textbook short-term uptrend. This move was strong enough to push the price above several short-term moving averages, giving tactical buyers the green light. Currently, the price is consolidating in a tight range, building energy for its next move. This corresponds with what analysts are calling a critical zone between 1.1540 and 1.1580. This area is a major battleground. A break above it would suggest the bounce has more room to run, while a failure here would likely see sellers regain control. Notice the increased volume on the initial push-up, confirming there was real buying interest at those lows. However, the volume has tapered off during this consolidation, suggesting indecision. For those of you trading on the shortest time frames, let's switch to the 15-minute chart. This gives us a microscopic view of the current price battle. We can see the price is essentially moving sideways in a tight consolidation pattern right now. Intraday traders are watching this range closely for a breakout. A sustained move above the local high around 1.1550 could trigger short-term buy stops and push the price towards that bigger 1.1580 resistance. Conversely, a breakdown below the local support around 1.1520 could indicate the bullish momentum is fading. This could signal an opportunity for bears to re-enter, targeting a retest of lower levels. The price action here is very choppy, reflecting the broader market uncertainty as we await the next major catalyst. Okay, let's pull back to the daily chart to put it all together and recap. The long-term trend remains bearish and sellers are still in control until proven otherwise. The short-term trend is bullish, driven by a bounce from a key support level and fundamental news that is weakening the US dollar. This has created a classic stalemate situation. So, let's outline the key price levels to watch. Critical support is the recent low at 1.1468. A break below this level would signal bearish continuation, with subsequent supports at 1.1440 and the major psychological level of 1.1400. On the upside, the most critical resistance zone is between 1.1580 and 1.1620. This area represents a confluence of the descending trend line and prior price structure. A decisive close above this zone is required to shift the medium-term bias to bullish, with initial targets at 1.1665 and then 1.1728. Now for some unbiased predictions. Scenario 1, the bearish continuation, has about a 55% probability in my view. This is because the dominant trend is still down, and this could just be a corrective bounce. This scenario would be reinforced if the upcoming U.S. consumer sentiment data on Friday is strong, or if Fed speakers push back against December rate cut expectations. Scenario 2, a bullish reversal, I would place at a 45% probability. For this to happen, bulls need to break that 1.1620 resistance. This scenario would gain likelihood if Friday's U.S. data is weaker than expected, confirming a slowdown and putting more pressure on the Fed to ease policy. The main thing to watch is how the price reacts to this 1.1580 to 1.1620 resistance zone. Rejection here favors the bears, while a clean break favors the bulls. Thanks for tuning in to explain the charts. If you found this analysis helpful, please hit the like button and subscribe for more content. Remember, this video is for informational purposes only and is not financial advice. Always conduct your own research and analysis before making any investment decisions. Trade safe, and we'll see you in the next video.